Every decade, the market creates a brief window of high volatility. Historically, these moments of chaos are when concentrated fortunes are built by those who recognize the shift first. Take the 2008 financial collapse. While most participants exited in a panic, a specific group of investors used that window to secure assets that would define their wealth for a generation. This chart tracks the 2020 market crash. You can see the point where prices bottomed on March 16th, followed by a sharp vertical recovery. In the 3 years that followed, investors in the right sectors saw their portfolios increase by orders of magnitude. Today, while retail sentiment is fixated on surface-level headlines, institutional funds are executing a silent realignment of capital, totaling over $1 trillion. Failing to identify the specific direction of this capital flow creates a significant risk of being left behind as the next decade of market leadership takes shape. Professional money managers rarely look at daily price ticks. Instead, they monitor the underlying plumbing of global liquidity to see where the actual cash is settling. That liquidity is currently revealing a stark divergence. This chart plots the S&P 500 against long-term government bond yields. The equity market is pushing toward record highs, but the bond market is simultaneously pricing in a long-term inflation risk we haven't seen in 20 years. This exact pattern appeared in 1999. While popular tech stocks eventually collapsed, a specific physical sector that the market had ignored began an 800% rally. Protecting your capital today requires identifying the physical assets that are absorbing this new wave of liquidity before the broader market catches on. In 1995, the skepticism toward the early internet was nearly universal. A few understood the trajectory, but most investors only realized the scale of the change after the first multi-billion-dollar companies had already been built. We are seeing that same skepticism today with artificial intelligence. However, the data shows that AI is already reorganizing the physical operations of healthcare, logistics, and national defense. This shift is backed by a realignment in capital expenditure. The world's largest technology firms have committed $800 billion to AI infrastructure this year, a figure projected to scale past $1.1 trillion shortly. While retail traders buy into overvalued software applications, this institutional cash is being deployed into the heavy systems required to make those applications functional. Globally, the geographic split is clear. While megacaps sustain the US market, South Korea's Kospi is seeing aggressive growth. South Korea has become the central hub for physical hardware. Their manufacturing giants report significant operating profits by controlling the components required for this expansion. If the entire world is racing to buy more AI chips, we have to ask, who is building the power systems required to run them? An AI data center requires significantly more electricity than a standard server farm. The demand on local power grids is reaching a level that existing infrastructure was never designed to support. The long-term winners of this cycle are the entities that own the heavy physical assets necessary to keep these digital systems operational. This brings us back to the market divergence from 1999. In that era, the assets that outperformed weren't just the websites. They were the companies building the physical layer of the internet. Trillions of dollars are currently moving into the production of industrial gas turbines, specialized electrical grid components, and raw copper mining. These unglamorous industrial sectors are where institutional funds are positioning themselves to capitalize on the energy demands of the next decade. Capturing this trend requires a high-momentum strategy to manage risk during periods of broader market uncertainty. This involves identifying companies directly integrated into the AI energy supply chain. We look for a breakout from a multi-month consolidation pattern, confirmed by a surge in trading volume that indicates institutional entry. Instead of holding an asset indefinitely, this strategy uses the 10% compounding rule, taking tactical profits at predetermined levels to secure gains while the trend is active. The gap between those who own productive assets and those who rely on traditional labor will likely expand as these technologies automate more of the global economy. Positioning yourself correctly means looking past the headlines and tracking where the institutional liquidity is actually settling. Subscribe to Streets to stay informed on these shifts before they become common knowledge.